Thank you guys for hopping on. We've got a couple of you popping in. I'm Jason England, founder and CEO of Freaky Fast Home Buyers and Investments. And doing a little bit different webinar here. Normally, we are usually maybe in the office or behind a desk. And I double booked my schedule today. I'm actually in Covington, Kentucky, about to go into Cincinnati, and we're just looking at a bunch of different properties that either A, we've just finished the rehabs, or B, we're about to start rehabs, or C, we're about to close on some properties. And then tomorrow we're going into Indiana, where we're closing on 30 properties tomorrow. And so I thought, you know what, let's do something. Let's do the webinar from one of the houses that we just rehabbed, and we can kind of give you a behind the scenes look at some of the jobs we do and kind of give you a good feel of just kind of the idea of Freaky Fast between the single family homes, our type of model, rehab, jobs. So you can see the quality of the homes that we're providing, both for our investors to invest in, and then also for our tenants or future home buyers to live in. And so it gives you just a really good understanding and idea of who we are and what we do. So I'm just going to pop in, and then at the very end, we'll just give a quick little tour of the house. So I'm going to share my screen here, and we're just going to pop right in. So thankful that you guys were willing to hop on and take a few minutes out of your day to learn a little bit more about our company, and also kind of learn and get a better education, I guess, of where the housing market is right now. And so really the theme of today's webinar is how to win in today's real estate market. I think a lot of people are kind of curious to see where the market's going to go. There's so much news out there. There's so many conflicting theories, stories, predictions, or even analytics in some cases that really make you question, really make you fear, doubt whether or not you should pull the trigger and invest. So I just want to kind of show you exactly why I think single family homes is a great place to invest right now in the current market, where the real estate is going, and how you can win. And so that's going to be kind of the theme of today. But before we do that, let me just hop in. Well, now my slide's not working. There we go. Let me just tell you a little bit about myself. I'm 33 years old. I started this company in June of 2019. So I was 29 years old, and grew up in a pastor's home. As you can see, my beautiful wife definitely outpunted my coverage. I always say that I shot for the moon and I actually hit it. She's a country artist. Her name's Tori Martin. Her last single on a country radio went number 42. Been in the investment sector for around a decade. Started off in oil and gas and worked my way into the real estate market after the oil market crashed there in 2016, 2017. And was kind of burnt out on that. And oil and gas is a very interesting investment, very risky, probably one of the riskiest investments you can do. And so I wanted to get in something a little bit different and something a little bit more fresh. And of course, everyone knows that real estate is where millionaires are made. And, you know, if you started like me reading Rich Dad, Poor Dad, it kind of gives you that taste for real estate. And so I moved into real estate in 2017, really started learning the business. And then, like I said, in 2019, started Freaky Fast. But what's really cool is a year prior to that, I started wholesaling. That's really how I got involved in real estate. Started working for a company based out of California. We were focusing on Nashville, which was one of the hottest markets at the time. And then they eventually switched directions and went to a different state and kind of had to start from scratch. And so I started my own wholesaling company with a friend of mine who was a contractor. And I wrote out handwritten letters and put them in the mail. And in the letter, it said, we buy houses with cash. And I was dead broke. I had $20 to my name, and my wife likes to crack that she was my first investor because it was her $20. But we bought 40 stamps, and we prayed over those letters. I was like, God, please, I got bills this week. I got to pay. I need a deal. and we mailed those out. And 2 days later, I got a call from a gentleman, and I was able to lock up my first deal, flip it within 24 hours to another friend of mine who was a fix and flipper, and I made a quick 10 grand on that, and then just started building up my wholesaling business, and did that for about a year, and then let that led into Freaky Fast Home Buyers and Investments. And just to tell you a little bit more about Freaky Fast, like I said, found this in June of 2019. We started off with 3 homes in Columbus, Georgia. And over the last 4 years, we've purchased and managed over 30 million in assets in 5 states. That actually changed this week. And so I left it at 5 states, just to kind of make a note that this week we just went into our 6th state, which is Indiana. And we are closing on 30 properties tomorrow, and extremely excited about that. But we're Columbus, Georgia. We're in 3 different cities in Ohio. We're in Kentucky, right across the river from Cincinnati. So it's really the Cincinnati market, even though it's in the state of Kentucky. We're in Tennessee and in Texas. We're looking to buy homes in Alabama this year, homes in Florida this year, evaluating a 76 property portfolio there in the St. Petersburg area. And so we got a lot of great things in the works. And then one thing that I do want to point out, we have created a lot of different ways for investors to get involved with Freaky Fast. And on the very low end, our investors have made around 9%. And that's being extremely conservative. The average that our investors have made has been around 14 to 15%. And so we're really proud of what we're able to do in the last 4 years. And just so you know where we're going and what direction we're working towards, this year we sat down and revamped everything. We built up this business with a very small mom and pop type of culture and systems and processes. And as the economy began to shift, I noticed that we needed to also transform ourselves if we were going to survive. So many real estate companies were going out of business. So we revamped and rehauled everything, and we upgraded to a more scalable software and operating system with systems and processes that will take us to the next level. We wrote out our year goal, our quarterly goal, and our monthly goals, and then our weekly goals to get us to that next point. So where we're going this year is we want to add another 400 homes to our management, which would put us at around 100 million under management. So those are our goals. Those are our targets. If we don't hit them, but we move towards that direction, that's still success. But I feel very confident just based off the deals that are coming across our desk, we're going to be able to hit those numbers. And I hope that you can be a part of it. So let me just tell you kind of what the plan is for the webinar, what you're going to learn today. We want this to be a very informative, educational webinar to kind of help you get great understanding or insight of where we believe the real estate market is going and what you can expect if you were to invest in single family homes. Again, like I said, there's so much conflicting data out there. You can turn on the news and listen to the same story, but on 4 different channels, it's going to be spun 4 different ways. And so that can be very confusing to the consumer or the investor. And so I kind of want to be able to give you a little bit of insight, and then also maybe explain why you should be investing right now. So a few things that we're going to learn today is, where is the market heading? Obviously, that is the crystal ball question. I just want to give you my projection and where I believe it's going to head, and then back that up with some data. The second thing is the hottest markets for single family rentals. There are some markets that we are currently investing in that are the hottest markets according to multiple sources of where the market is really trending and going up. And so we're going to cover that. Why is the current housing market still strong? I read an article earlier this week that, to the chagrin of a lot of experts and economists, the real estate market has stayed stronger than what people were projecting. We thought it would really just kind of crash. And even though there has been a little bit of a correction, it still actually remained pretty strong. So we're going to discuss why that's the case. Inventory is down and prices are stable. That's pretty much the case right there, but we'll dive into that a little bit deeper and help you understand the data behind that. And then rental prices, they're continuing to rise. And so we'll cover why those are happening, although it doesn't take a whole lot of rocket science to understand the rental prices and why they're going up, but we'll cover that very briefly. So those are the things that we're going to learn today. So let's just dive right in and we'll go from there. Where is the real estate market heading? I've talked to investors every day, investors from all walks of life. Some guys are in their 70s, some guys are in their 40s, some guys are maybe just coming into the investment game and they're in their early 30s. And so these guys and gals have a lot of different experience based off of maybe where they live, how long they've been investing, what they do for a living, how they make their money, what their current investment portfolio is, and how diverse is it. And so you begin to pick up things, you begin to hear, things that they're hearing and they just kind of pass it along, or maybe what they're reading, or maybe their analysis of what they're hearing or what they're reading. And so you get a lot of interesting feedback. And then sometimes you get a lot of wisdom, especially coming from the older guys who've been around the block much longer than I have. And I always try to listen to them and glean the wisdom off them. So where is it going? Well, nobody really knows. I think you could have 10 real estate experts here tell you their opinion. And in some cases, a lot of them will line up. And then in some cases, you'll get 10 different answers. And so that can be kind of confusing. So really the best thing to do from my perspective is to be able to kind of share with you where I believe it's going and kind of back it with data and numbers and then let you decide. But my mentor once told me this when I first got into the real estate business. In fact, he was the gentleman that I sold my first wholesale property to. He said, his name's Doug, and he said, Jason, the stars may lie, but numbers never do. And I've never forgotten that. And that's really how you win in this game is your numbers. If you buy at the right number, if you have the right rehab number, if you have the very realistic sales number, you're going to be successful. And that same principle applies with data. The numbers won't always lie, or the numbers do not lie. So when other people may be lying or maybe putting in their opinion, they're kind of twisting it a little bit to back their opinion. The numbers, they always speak volumes. And so that's what I find to be very, very interesting. So just a couple things that I some interesting points I wanted to hit on this, as you've probably already been reading as I've been talking. The U.S. market just reached a new all-time high valuation of 47 trillion. Guys, that is crazy. And the thing is, it's only going to go up. And it's going to go up because of appreciation, obviously, but it's also going to go up because we are in a huge shortage of properties. And so we are building at a rapid rate to try to catch up. And when I say we, I mean us as a country and as an economy. And we'll get into that a little bit more. So I don't want to steal the thunder of that point, but that value is going to continue going up as we start adding more property and as properties start appreciating. 9 out of 10 homeowners with mortgages currently have rates under 6%, well below the near 7% levels seen since the end of 2022. You say, okay, well, that's an obvious. Why is that so important? Well, here's the reason why. Because right now, that is keeping the market strong. You see, a lot of people have got great mortgages and great rates right now, so they don't want to sell and have to start over. They want to hang on to their property. They're going to hang on to that mortgage. They're going to hang on to that low payment, and they're going to stay there. But here's the problem. We are facing one of the largest migrations in the history of the United States with the millennial generation moving into single family sector. Problem is there's just not enough inventory on the market for those first-time home buyers to buy anything. And one of the main reasons is because people that have homes right now, that have equity, that have entertained the idea of selling a property, is holding tight because of the fact of, one, they got a great mortgage and they're going to have to, if they sell that, they're going to have to get a new mortgage at a higher rate. And they don't really want to do that. And then two, there's not a whole lot of properties to choose from if they were to sell. So the fact that again, 9 out of 10 homes have rates under 6%, you're going to see less people selling their properties and just kind of sitting tight to see where the interest rates go. And because of that, it's going to keep this real estate market very, very hot. And we'll dive into that a little bit more. Home values will continue to hold up, especially in the rural areas. But at the same time, we're seeing home values pretty much stay strong in just about every market except the major metropolises, like the San Franciscos of the world. They're taking a hit. But you're talking about like the Cincinnatis and the Knoxvilles and cities that are what I would consider maybe like a B tier or a second tier. They're staying really strong. And again, part of the reason is just for the fact that inventory is super low. So that kind of gives you just a little bit of just some data points of why I think the market's going to stay where it's at and maybe go even higher. The hottest markets for single family homes right now, surprisingly, is the Midwest. I know that's shocking, and I'm sure that may surprise a lot of you. The Midwest is usually the part of the country that takes the biggest ribbing, I guess, or gets crapped on the most. I would say 2016 through 2020, 2021, the Southeast was really hot, and it's still very hot. But the Midwest is very, very strong. As you can see, there's a graph there just showing you, I believe this is Cincinnati, just the days on market has dropped considerably and is still very, very a buyer's market, or excuse me, a seller's market. Properties are flying really quick. We listed a house a month ago, and within 7 days it went under contract and it sold really, really quick. So it's moving fast, and I like that. And one of the reasons why we're seeing the Midwest producing at such a rapid rate, one, because the job growth in the Midwest has grown considerably. A lot of companies moving in. If you look at Cincinnati, you got several Fortune 500 companies already here, like Kroger's, Procter and Gamble, Gillette, for the razors, from men's razors. Just a lot of business moving in. Amazon's building warehouses out here left and right. Also, unemployment is at a low here. It's below 3%, or right around that 3% mark. And so you're seeing a lot of families, especially millennials, moving into the Midwest because of the jobs, because of also where the markets are going, in the sense of you can still get a really good quality house much cheaper than you would in a Nashville or in a Dallas or maybe in Tampa per se. So some of these hotter markets like Atlanta in the South, they're a good house would maybe be over 400,000. In the Midwest, you can get a really good quality, beautiful home that would sell for over 500, maybe in some of these bigger cities, for around 350. So it's affordable living, and yet you're also seeing a lot of job growth. So the Midwest right now is extremely hot. Wall Street, and it's, I believe, a couple slides down. Wall Street Journal had an article that said Indiana and Ohio were the two hottest states, and out of the 20 markets, they were primarily in Ohio and Indiana. And those just so happen to be two markets that we are in or just got in, like Indiana, with the new purchase that we have tomorrow. Why is the current housing market still strong? I'm going to move this so I can read this a little bit better. The reason why the current housing market is still strong, one, inventories are still very low. That started back in the Great Recession in 2008, 9, and 10. And if you're familiar with the real estate market, new construction really took probably maybe the hardest hit. A lot of contractors went bankrupt, they went out of business, they lost a lot of money. And one of the reasons, because they had properties that they built, but they didn't have buyers, and so they sat. And so for a few years, it literally came to a screaming halt. And so because of that, we were already at a shortage. Then you throw in COVID in 2020 into the mix, and that just made it worse. You had materials becoming harder and harder to come by. Material prices skyrocketed. And we didn't really know what was going to happen. It was a whole new process and learning period for America. We didn't know what COVID was and how long it was going to be here and how it was going to affect us. And so we kind of went day by day. And because of the previous experience that that contractors had building new construction in 2008, 2009, 2010, they slowed down. They didn't want to get caught in a similar situation. So that increased the numbers of how many properties we are behind for the demand that we are currently facing. And we'll show you some of those data points here in just a little bit. But builders that weren't building quickly enough to meet that demand, and then you throw in, those different slowdown periods, and it just made matters worse. Demographics or trends are creating new buyers. That is primarily the millennial generation. You're seeing the millennials move out of their parents' basements. You're seeing millennials moving out of the apartments that they're sharing with 4 of their roommates, and they're moving into the single family sector. COVID sped up that process. After being quarantined for a year or so in a small proximity, people wanted to get into that single family home. And so that also forced that migration to increase at a pretty rapid rate. And again, we just don't have enough inventory for that. Another reason why, and I think this point gets missed so often by so many people, is point number 4, lending standards remain strict. The reason why 2008, 2009, 2010 happened, or the primary reason, is because lenders were not necessarily doing the right steps, if you want to call it that, to approve mortgages. They weren't necessarily requiring people to verify their income and to make sure that they could afford the loan that they were about to take. And so when the market crashed, Congress stepped in and they started creating more guidelines, more restrictions for lenders to apply to the approval process for a loan. And because the fact that they have become much stricter, you're not seeing a lot of shady loans being made. And for that instance alone, the market's staying strong. People are getting loans that they can afford. Now you say, well, what about interest rates? They've gone up. Okay, so let's just say that a young couple could afford a $450,000 home at 3-4% interest. But now that's jumped up to 7. Okay, maybe they can't afford a $450,000 home, but they can still afford a $300,000 home. And so basically, it just kind of sets the bar a little bit differently with their buy box, but yet they still need that home. They still need a place to live. And with the guidelines and restrictions that the government has put in place for lenders to use, it has really kept things kind of in lockdown and tight ship. And so I think that's a very, very important fact to always remember when you're getting involved in the real estate market and trying to figure out where that market is going. Last but not least, foreclosure activity is muted. Back in 2020, so many people are like, oh, get ready. We're about to see one of the greatest wealth transformations in the history of this country. There's going to be so many foreclosures on the market, and you're going to be able to pick them up, but be ready. Make sure you have dry powder to do that so that you can, take advantage of the opportunity. Well, that never happened. Well, here's why it never happened. Because the appreciation of those properties skyrocketed. So somebody who wasn't necessarily maybe able to afford their payment, all they had to do was list their house on the market, sell it within a very quick time frame, prevent going to foreclosure, and they made probably a pretty healthy profit because of the equity that went in. So that really hindered the foreclosure activity. Now that could potentially change. We were starting to see more foreclosures happening. We've been able to take advantage of some subject to opportunities, and I'll share some of those with you. But even then, it's still not like what most people were projecting. So it's tough to say where that could end up. But right now, because of that appreciation, it's really prevented a lot of foreclosures. So without a lot of foreclosures, it really helps the market kind of stabilize. So those are a few things of why the housing market is still strong. Again, to the chagrin of a lot of real estate experts, and an economist. So hopefully that helps you have a better understanding of why we haven't seen a complete fallout. Inventory is down, prices are stable, so we did kind of hit that, but I want to just show some of these. So the household formation gap rose from 5.5 million at the end of 2021 to 6.5 million. That means we have a need for 6.5 million homes right now. And even if we started building at a rapid rate, we're still not going to hit that mark. And because of that, there is such a demand right now for properties. It's helped keeping the market stable. Here's what happened. Okay. If you go back to when the interest rates started going up in July and August of last year, you had a lot of people who were hanging on to their houses because they wanted to wait till the market got to the top. And as soon as the interest rates went up, they threw their houses on the market, hoping that they could sell it. And you had a lot more properties on the market, and they were staying a lot longer because a lot of people now had to change their direction because of what they were able to buy because of the interest rates. So what you saw was a little bit more inventory on the MLS. You were seeing them sit a little bit longer, and it caused a slight correction in the market, a very slight correction. And that lasted from the end of the second quarter into the end of the third quarter into the fourth quarter and the first quarter of this year. But what happened in the second quarter of this year is things started to pick back up. April and May were very hot months for a lot of the real estate experts, not experts, but the real estate industry. For people who are selling properties, home purchases were going up. Where things were still a little bit slow were for investors who are wanting to buy extra rental properties, because now they're paying, around 8.25, and they just didn't think that the juice was worth the squeeze. So the investor sector kind of still remained a little bit slow, but the homeowner purchases started going up, which allowed the market to rebound. So those are two important reasons why it hasn't changed. But if you look at this one data point that I want to share with you guys, if housing starts were to increase by 50%, it would still take 2 to 3 years to close the existing 2.3 million home gap. Think about that. If we were to go another 50% increase of our production, we would still not be close to hitting the demand that we need. So again, that's why it's so important just to know why I believe the real estate market is still very strong and why you should be investing in it. So let's go ahead and move to the next. Okay, this is something that's common sense, but yet I just want to hit on it real quick. Rental prices are continuing to rise. Why? Because now there's not as many people able to afford buying their homes because of interest rates, but then two, because there's not a whole lot of inventory right now. Again, like I said earlier, people that maybe were considering selling their homes are holding off because their mortgages are so good and their mortgage payments are really low, that if they were to sell, then they would have to move up and get a loan at a 7% interest rate. And so people just don't want to do that. So inventory is low, but people still need a place to live. So now if they can't afford to buy, or if they can't find a house to buy, they're getting into the rental property. And even if it was for just 12 months to see what happens if interest rates were to drop, then so be it. At least it's just 12 months, it's just a year. But what that is doing is it's causing rental prices to go up. And the reason for that too is because there's just not a whole lot of rental properties. So we're seeing rental properties going up in value anywhere between 150 to 300 a month in the markets that we're in, and we're seeing less than 14 days usually listed. And so it's been kind of aggressive mad rush to find the rental property. So if you are able to provide a good quality rental, you're going to be able to get a really good quality tenant and a really good quality rental cash flow for that property. So now is the time to invest. And we'll get more into that here in a minute. Okay, this is just a couple news articles or headliners, or even just some quotes that I picked that I wanted you to see. Like I said, the Wall Street Journal has the Midwest as the top emerging housing market. We're seeing multiple cities and towns in the Midwest, primarily Ohio and Indiana, that are really leading that charge. And so just for your own sake, if you want to just kind of look at some of those quotes, just to kind of verify and fact check what information that we're giving you guys. But I love the Ohio market. It's a gold rush. Indiana is a great market as well. We're trying to find good quality markets that are very landlord friendly. There's a lot of markets. For example, I'm not interested in investing in Michigan and Detroit for that matter. The reason is because it's very tenant friendly. You can get a tenant in your house for over a year, sometimes 2 or 3 years without paying rent, and it's almost impossible to get them evicted. And so just because you can get a really good deal in that market doesn't necessarily mean it's a really good deal for you, the investor, the landlord. So I'm finding markets that are more landlord friendly, but yet still have a lot of meat on the bone, still able to get some really good deals. I mean, we're buying houses here, and we'll show you a couple in Ohio for anywhere between 40 and 60 cents on the dollar. If we're buying at 60 cents on the dollar, it only needs anywhere between 10 and 20 cents to get it to 100% market value. If it's 40 cents, then it's a little bit more. But the whole idea right now is to find good deals that are going to cash flow and that are going to provide really good returns. And the Midwest is doing that for us and our investors. Okay, I love this quote. So I gave you the data. I gave you the information of where I think the real estate market is going and why I think it's going to remain strong and why I'm investing. Here's something though that I want to share with you guys. So like I said, talk to investors every day. And the main objection that I come across from these potential investors looking at our deals is this: I think I might sit on the sidelines and hold on to my cash and just wait and see where the market is going. Now that logically might sound like a good plan. However, it's not a good plan. And I want to kind of explain why that is. And I was reminded of this quote by the great Vince Lombardi. Most NFL historians say he's probably the greatest football coach, or at least top 3 that ever was. And one day, I believe it was a Monday, right after a horrible loss from the Green Bay Packers, he was furious. And so at practice, he huddled the team together and he goes, guys, we have got to get back to the basics. We have got to get back to the fundamentals. And he goes, so we're going to start from scratch. And he pulled out a football and he said, gentlemen, this is a football. And we laugh at that and we think that's hilarious, but there's so much wisdom in that. Sometimes we get so caught up in everything around us that we forget sometimes the simplest basic truths. So I'm just going to take some maybe 3-4 minutes and go through some of the most basic investment advice, tips, strategies that we've all heard a million times, but they work. But what's so incredibly amazing to me is how many investors forget them and they freak out and they panic. One of my favorite movies, well, my favorite movie of all time, but one of my favorite quotes is from Wonderful Life. And old man Potter is trying to hire George Bailey. And he's sitting there and he says, George, after the bank run, 2 people kept their head, me and you. And I want to hire you. And to me, that sticks out so vibrantly, because in chaos, when markets seem to be shifting, there's a lot of volatility, whether it's in the stock market or maybe it's with employment or inflation or whatever the case, people start to lose their heads. They start to panic and they start to freak out. And it's the guys that keep their heads and take advantage of the opportunities that get rich. And I say get rich in the sense of not a bad way, but they're actually setting up generational wealth for them, their families, and they're able to give back to people in need. And they were able to do that because they kept their head and they took advantage of the opportunities that the market provided. So I want to share with you just a couple of basic tips. Yeah, I guarantee it, you've heard this: buy low, sell high. Well, why are we waiting right now to buy? Well, prices are dropping and I feel like the market's going to continue to collapse. Well, we just showed you some reasons, some data points why the market's not just going to bottom out. We're not going to see another 2009, 2010, where we lose 30, 40% of the value of homes. It's just not going to happen. We might see a 10 or 15% correction. And historically, that's usually what it is. And it only lasts about 12 months, maybe 24 months, and then it starts to rebound. And I'm going to show you with some numbers on a real property that we just did to validate that one statement. But buy low, sell high. Right now, prices have dropped. So let's take advantage. Now, the prices that have dropped are prices of homes that are distressed, homes that maybe the seller is in a bad spot, whether it's a health issue, a foreclosure, a divorce. Maybe they took a job outside of that area, that market. They got to go to a different state. They need to sell quick. A lot of the investors were buying at such a rapid rate that they've got too much, and now they're over leveraged and they just need to dump and get their money. So for whatever reason, there's opportunities, even though the real estate market is staying strong, in some ways rebounding, there's still opportunities to buy at a very low price because of the previous 6 months that we just went through. So buy low, sell high. I love this quote from Warren Buffett. It's been an ideal period for investors. A climate of fear is their best friend. Those who invest only when commentators are upbeat end up paying a heavy price for meaningless reassurance. He's saying if all the news that you're listening to is upbeat and that's why you invest, then you're paying too much. However, if you're not investing because of everything you're hearing and they're creating this fear and panic, then you're missing out on taking advantage of the opportunities. So buy low, sell high. If you buy low and the market goes lower, that's okay. Buy again. Keep buying, because one thing that we do know is what goes down is going to go back up. We saw that in 2020. It happened a lot quicker than a lot of people anticipated, but it went low really quick and then it skyrocketed, it shot way back up. And that's what's going to happen in the housing market, and it's already starting to do that. So right now is the time to buy. Don't wait. Don't sit on the sidelines trying to figure out what's going to happen with the market. If it continues to go down, keep buying. But what happens if it goes up? Well, then you missed out on some really good opportunities. And there's a really good opportunity of that happening. I read earlier today in the Wall Street Journal an article where it was talking to a real estate expert, and they said right now it's really difficult for millennials to be buying because there's just not a lot of inventory, and because a lot can't afford it at 7%. However, if for whatever reason the Feds lower the interest rates to around 5% again, it's going to be a buying frenzy. Well, that could happen sometime next year. We don't know. But if it does, all of a sudden you're going to see that market jump again. And for the people who sit on the sidelines right now, they're missing out. They're losing money. Be fearful when others are greedy, and greedy only when others are fearful. There's a lot of fear in the markets. So now is the time to be greedy. Now is the time to take advantage. Again, very simple truths. Next, tangible assets and cash flow. Tangible assets and cash flow. Why should you be investing in real estate right now? Because first of all, it's a tangible asset. It's not going to evaporate. It's not going to go away unless if a nuclear bomb hits. Then in that case, investing in real estate and your money is not really going to make a difference anyways. And I say that jokingly because in reality, there's very low risk to tangible assets. Sure, maybe tenants don't pay. Sure, maybe they damage the property. Sure, maybe a storm or a fire or something, but that's what insurance is for. You have a tangible asset that's only going to continue to grow in value. If you bought a house in the 70s and you held on to it, you've seen that value just continue to skyrocket over the last 50 years. It's only going to continue to happen. So tangible assets, and then of course, everything that everybody's heard is cash flow. Cash flow, cash flow, cash flow is key. Every real estate guru, every book that you read, every conference you go to, you always hear cash flow. Why? Because it's so important. So let's just say, for example, and let me see if I got a property here. I'm going to come back to these two slides. Okay, this is a property that we just purchased. We went through the rehab, and it's actually about to go on the market. Okay, so $115,000 purchase. The rehab was $20,000. It was in fairly good shape. The buyer had to get out really quick. He took another job. There was a plumbing issue, and he really didn't know how to fix it himself. And it created some issues with some flooring and the painting and some things like that. But really, we were able to pick up a fairly decent house way below the market value because of a couple different circumstances. Put $20,000 into rehab. We're going to list this on the market at 185. My realtors think it could hit as high as 195, 200, maybe even 205. But conservatively, it's going to hit 185. That gives me a $31,500 profit and a 23% ROI. Now that 23% ROI is within a 90-day period, maybe 120 max. I mean, we've only had it for a little over 30 days. And we just listed it on the market, and it goes live this week. So I fully anticipate it moving really, really quick. So if you're looking at 23% over a 90 to 120 day period, your IRR is much higher than that. This is a great deal. But let's just say the market drops tomorrow. I mean, it's just a catastrophe. It goes down and we lose 40% of our value. Okay, I want you to think about the numbers for a second. I'm still going to be able to rent this 4-bedroom, 2-bath house for around $1,500 a month. Okay, so here we go. Just going to do some real live numbers with you real quick. So you're all in it for $135,000, and it's going to rent for $1,500 a month. So times 12 months, that's $18,000 for the year gross. You're going to take out, your property management fees, your taxes, your insurance, your maintenance fees. So I usually take out about 35%. Some investors do more, but let's just take out that 35%. So that's going to leave you $11,700 in net profit, cash flow. Now let's base that off of the $135,000 we have in the house. That's at 8.7% return. Think about that, guys. That's with a 40% correction in the market. An 8.6% return. Now we know that values are only going to go back up over a period of time. So why is cash flow so important? Because if there is a catastrophe in the market and values drop and you lose your value, it's okay. Sit tight, just cash flow it and ride that cash flow to where it goes back up in value. So let me ask you, if you were in my position and you had the opportunity to buy this house with the thought that there was going to be a 40% correction still after what we've already experienced, but you can make a very conservative 8.5 or 8.6% return on your money, would you do that? Of course you would. Where are you going to be able to get 8% in a market that drops 40%? I mean, if we drop 40% in the real estate market, that means stocks are going down, oil and gas is going down, banks are going down. Now maybe you're lucky to get 3 or 4 or 5% on something that's very low risk. So that is why we invest in real estate. That is why cash flow is so important. Now, the good news is I don't think we're going to have another 40% decrease. In fact, I feel like that's very unlikely. I mean, probably less than 5% of that happening. So what we're seeing is still great deals, and this is just proof in the pudding of one of the deals that we're doing. Now, I want to go back to this real quick. We just got a few more minutes, and I appreciate you so much watching this and staying with us this long. And I just wanted to point out just a couple things. Okay, so let's see here. This slide is from 2022. So this was a property that we currently have. The ARV was around 186,000, maybe as high as 210, 220, depending on our comps. And these are some comps that we pulled back in 2022. We put it on the market and it sat and it sat. And as it sat, prices continued to come down and it sat some more. So I decided, okay, well, let's rent it out. So we put a tenant in there. It's renting around $1,400 a month and just wrote it through. Well, let's see what happens. So now we've seen the market go up when I bought this house and it start to go down. My property sat, so I just rented it and I cash flowed it. Let's see where the market is now, a year later. This property is now valued at $274. You say, well, how did it jump? It's because the values of the market is going back up. These right here are comps of houses that are very similar to my house that all have are within half a mile of my house. And the values of these properties that sold in the last 6 months, 2023, has increased considerably, giving me now a value of 274. So now, even if my tenant has roughed up the house, which this tenant did, I could go in for maybe another 15 grand, really spice it up, maybe even throw a little bit more cash, put it on the market and sell it for a higher price now than what I thought I could get last year at this time. And I'm seeing this in multiple markets. This isn't just Cincinnati. I'm seeing this in. I'm seeing this in Tennessee. I'm seeing this in Georgia. I'm seeing this in Indiana. So the market is starting to rebound. And let's just say it dips again in the fourth quarter and the first quarter. Maybe the Feds raise interest rates another quarter point, and maybe it just slows things down a little bit. That's okay. You just cash flow the property and you ride it through the storm. And then when values go back up, you get the tenant out, you rehab the house, and you put it on the market and you'll win. So that is why cash flow is key. So I just want to show you a couple houses that we just bought. Vinepress was one. Here's another one that we are actually putting in our fund. And this is one that you, the investor, has the opportunity to invest in. So this property, we purchased it as a subject to property. What that means is the homeowner was facing foreclosure and we were able to go in, get the payments caught up, assume the mortgage, and then just pay them a little equity and to get out of the house, or a little profit to get out of the house. So we purchased this house at $90,000. I only had to put $30,000 down. So we're all in at $30,000 and we just assume the mortgage, and the mortgage is at around 3%, which is great. And the value of this home is $215,000. Now in Eastern Rehab, so I'm going to go in with $50,000 and rehab it, and I'm going to list it on the market for $215,000. Now this is a pretty good size house. It sits on 2 acres, kind of a rural area outside Cincinnati. Very good chance that the prices could even go up even more. Well, let's just say at $215,000, that's a $53,000 profit after realtors fees and commissions. Now, remember, even though we purchased it at $90,000 and we've got $50,000 rehab, so we're all in at $130,000. We only had to put $30,000 down to get this house. Let's just say that we had to pay another $5,000 over the next 6 months for the rent. So we're all in, really at 35, but don't even worry about the mortgage payments. Just the 30,000 plus the 50,000, we're all in at 80,000. A $53,000 profit is a 67% ROI cash on cash. Now, let me ask you, as an investor, would you do that deal? Of course you would, or you should at least. And these are deals that we are putting in our fund right now that you, as the investor, can invest in. These are the type of deals that you can capitalize on. Let me show you one more. So that property is a fix and flip that we're going to do. And the reason we're going to do this instead of keeping it as a rental is because the equity is so much higher than what we're in, that it just makes sense to go ahead and sell that and cash in on that equity, realize that profit, and then reinvest it. Here's one though that we're going to keep as a rental. Okay, it's a property right outside of, or it's in Akron, about 6 blocks. So maybe a mile and a half from the university. We're going to turn this into student housing, 4 bedrooms, 2 baths. It's got another room that we can maybe add a 5th bedroom, even though it's more kind of like a dining area. As you can see, it's a little bit rougher, But 79,000 ARV is 170, and that's a very conservative ARV. And we're going to put about 45,000 in for rehab. And this property is going to rent for 2,800 a month because we're going to rent them out by the rooms. Great cash flowing investment property that's only going to continue going up in value. You're never going to have to worry about tenants because you got students that are going to be renting this out and are needing properties. So you're going to be able to get a good quality home that's going to cash flow around 15-17% on your money, and you're going to have about a $47,000 equity. So here's the great thing: we can go in, refinance this, pull out our initial investment, and redeploy it into another property, which is going to cause that ROI to skyrocket based off of the loan to value that we get, whether it's 70% or 80%. We're going to be able to create a much higher ROI for the investors, but then take that capital and redeploy it into another property and multiply the value of the fund. So again, just another deal that we're doing. So real quick, I just want to share with you why Freaky Fast is a great opportunity to invest in. We want to create as many and passive investments in the real estate sector for you, the investor. And these two funds are the first two funds that we've ever done. And we started the property fund one in, I want to say it was the third quarter of 2020. And then we started the property series fund 2 in November of 2020. And over that period of time, as you can see the numbers here, the annualized cash on cash, that's from the distributions from the rental income, 16.71% for the series 1, 11.65 for the series 2. The IRRs, 37% and 21%. Those are really, really solid investments. However, they've also grown in appreciation. So the multiple there, as you can see, is quite strong and quite heavy. Those are our two previous funds. Our newest fund, which you've already received the information when you maybe saw our ad on Facebook or YouTube, or maybe you have one of our investor or relations managers reach out to you and send you the information. You can see that this newest fund is set up even a little bit differently to even help increase and multiply the value of your investment even more. The main reason, and I won't belabor this point too much, but these two funds purchase turnkey properties at a 90% market value, and those are the type of numbers they got. This newest fund that we have is set up to do a 70-30 split. 30% of the fund will go towards turnkey properties at a purchase of 90% market value. However, the other 70% is to find properties that are distressed, and we're able to pick up, like I said, between 40 and 60 cents on the dollar, just like the properties I just showed you. And by doing that, we're going to be able to immediately provide a 20% equity right off the bat, because the model for us is to buy homes again between that 40 to 60% range, and then rehab it for another 20 to 40 cents. So we're all in at 80% of the market value, giving you a really healthy equity right off the bat. And our average appreciation in these markets are between 7 and 10% annually anyways. So our new fund, 3-year minimum investment, the goal is to take it from 10 million to 30 million over that 3-year period. And in the meantime, provide on the low end a 10% annualized cash flow for you on a monthly basis. With those added flips, like the township property I just shared, we're going to be able to increase that annualized return anywhere between another 3 and 7%. So that 10% is just from the rental income, the cash flow from the rental properties. And then when we start mixing in some fix and flips because of the margin, it's going to cause that to spike up. So our goal is to provide at least 10%, if not 15% annualized to the investors, and then be able to give a lot larger multiple after 3 years based off the appreciation and the equity that was already in the property. So that is who we are. That is what we're doing. And I hope that this webinar helps inform you of where the market's going, and maybe encourage you or give you that push that you need to get out of waiting on the sidelines and into the game. Now's the time to invest. Don't wait. If you're sitting on cash right now, you're losing money because of inflation. The value of the dollar is going down, but you know it's not going down? Tangible assets. And if they do happen to go down, they're going to bounce back. So now is the time to invest. Now is the time to take advantage. And so that brings us to the very end of the webinar. If you like to reach out to us and talk to us more about the investment opportunities that we've got, then please reach out. Alex is one of our investor relations managers. He is on the webinar with us, and he's going to put a link in the chat box. So if you'd like to schedule a call with him or one of our other advisors, then you can just click that link and fill that out. I'm going to open up the chat box and just see here if we've got any questions. I'm going to open this up for you guys to look at and or to answer. The chat box is disabled. I don't know why or how. Is there a way for me to do that? Undisable it. I am not the most tech savvy guy, so please forgive me. Let me see if I can. Okay, I think everyone here. All right, so I believe I just opened that up. And Alex, if you do see some questions and I just can't see it on my end, feel free to unmute and read the questions to me. But while you guys may be waiting or putting in your question, let me just show you this house that we just rehabbed and we just put on the market in Covington, Kentucky. And a cute house, nothing super fancy. This is definitely a house what I would call affordable housing. We put granite countertops in, new shaker cabinets, and have appliances and fridge there. We got just a real small basic bathroom here. It's a 2-1. I know that it's probably not the most perfect camera views, but just kind of want to show you this house so that you can see it. We bought this house for $45,000. It's an older home, needed a lot of work. We put around $100,000 into the rehab. And a lot of that rehab was what you can't see. Stuff behind the walls and in the basements and framing and foundation issues. It's a 2-bedroom, 1-bath house with a pretty good sized dining room area. I don't know if you guys can see that or not, but just a really cute property. And so we're all in it for around $145,000, and we're going to list it on the market for $210,000. So again, just a really good investment opportunity for us and our investors. And these are the type of homes that we like to buy. Again, what I consider affordable housing. The average of our homes are around 250, 300,000 is usually our max. Every once in a while, we might get a house that's above that. But normally you're going to be all in around 150 to 200, 250 is usually where we're at. Properties that are going to cash flow, rent for anywhere between $1,200 and $1,600 a month. But they will continue to go up in value over time, whether it's even on very conservative 5% appreciation. If you were to buy these properties and hang on to them for, 15, 20 years, they're definitely going to go up in value. And just a great way to even pass off to the next generation in your family a good solid investment. So these are the types of deals that Freaky Fast is acquiring and purchasing. And if you've got any questions, feel free to answer. And if not, we'll give it another minute or so and then we'll hop off. But I want to thank you again for taking time to watch this. I know an hour of talking on a webinar is not necessarily the most exciting thing in the world, but thank you for giving us your time. Hopefully it was informative. It helped answer any questions that you may have of where the real estate market is going. And 2 things I do want to say fairly quick. So the fund that we're offering that you received the information for is for accredited investors. However, if you find yourself a non-accredited investor, but you're looking to invest, our company does provide and offer opportunities for non-accredited investors. And we try to help get you into the real estate game with where you're at right now currently and help you achieve that accreditation And so if you find yourself non-accredited, still reach out to us and let us chat with you and see how we might be able to help you start investing. And then if you are an accredited investor and you're looking for a good quality investment opportunity, I can assure you Freaky Fast is the company you want to do business with. And so please reach out to us. We'd love to chat with you and share with you what we're doing and see if we can earn your business. I don't see any questions, so I'm going to sign off. But again, thank you so much. Hope you guys have a wonderful day, and we look forward to hearing from you. Talk to you later.